I use a trend following system which is overall performing well and has a decent expectancy, and I've observed that my equity remains underwater for a prolonged period. To optimize returns, does it make sense to trade the equity curve? That is applying the moving average to equity curve, stop trading systems when it dips below moving average, and resume trading when it moves above it. Or maybe risk off when it dips below moving average and risk usual about when it's above moving average. Posted by Vicky. So this is really a very good question, because people who are already into systemized trading, they always wanted to minimize their overall risk. They don't look for increasing their overall returns. They just wanted to focus on containing their overall risk. So what I have observed, so the basic question behind this is he wanted to observe how his trading strategy behaves. So say suppose if a trading equity curves moves up slowly and steadily, he wanted to know, like, if I apply a moving average to that equity curve, and basically as long as the market is in sync with our strategy, our equity curve tends to do well because the strategy makes profit and our equity curve tends to move up and up. Sometimes if our strategy is out of sync with the markets, then it obviously gets into drawdown phase. So he wants to know, if we apply a moving average to the equity curve and see, okay, this is going below moving average, which means that primarily it tells me my strategy is out of sync with the market. So I wanted to switch off my system for now. And then you'll switch it off, you'll not trade live, and you'll trade it in a no paper trading environment and track how it progress. And eventually if it comes above its moving average of the equity curve, you'll resume trading. So he wanted to switch off the system or trend following system when it is out of sync with the markets, and resume it once he feels that okay, the market is back in sync with my strategy. So the problem with this kind of approach is, the first thing is, see, always a trend following system or breakout system will be in drawdown most of the time, because 80% of the profits will come from less than 20% of the trades when you're following a trend following approach. We never know when those big trades are going to come, and the moment it comes, it gives you so much of returns. It gives you so much of profits in just couple of trades, which not only can recover all your past losses, past little losses, it can end up giving you huge profitable yearly returns. But the only thing is, we need to be adapt to those streaks of losses that can happen every now and then. But the approach towards applying a moving average or applying a 22 days breakout, so I have seen one article related by Lauren Bernard, written by a hedge fund from Hong Kong. So this hedge fund manager, when I was having a conversation with him in Korea, he just gave this explanation. See, for an example, you are driving a car, and if the car is going towards an uphill, then obviously you need to accelerate more so that you could move up the uphill. And obviously when the car is going on a down slope, you need to handle on the brakes so that you don't hit anybody and you could drive carefully. So you are changing your acceleration based on uphill or on downhill when you are driving a car. Similarly, you need to do the same approach with respect to your trading strategy as well. So when the strategy is really going well, you just press the accelerator, just continue trading the system. But when the strategy is going downhill, if it is not in sync with the market, you just press the brake, so that you either reduce the risk or stop trading the system. So for that, he applied a 22-day higher high, and I mean just kind of a dawn child breakout. He applied a 22-day high and 22-day low towards his equity curve. So whenever his system is near to that 22-day high equity curve, he'll trade that system. If it goes and touches the 22-day low, then he'll stop trading that system. And that is how he used it. But I would not suggest this kind of approach because of two things. So first thing is, yes, you could definitely control your risk to a greater extent, but when the market tries to recover from the drawdown, so with trend following, the thing is good, or the bad thing is, it can recover the drawdown in just 2 or 3 trades. That is the problem with trend following system. We never know when that 2 or 3 trades could come. So when you switch off your system by following this moving average adaptability on equity curve, and if those two big trades happen to be on that time, then you lose out the opportunity to recover from the drawdown. Not only that, you are if you're reducing your risk, again you are taking more time to come out of drawdown. So it's better not to apply these kind of no moving average or no 22-day or 22-day low high kind of thing on equity curve and trade that system. Even though it help you to control risk, it would really take a long time to come out of drawdown when you follow this approach. So definitely I would not recommend it.